Welcome to another weekly market insight where we try to sift through the noise to get the signal to give you actionable advice so you can make informed decisions. Joining me today is Chris Ahrens from the Investment Committee, and today we're going to talk about the Annuity Bagaboo, whether it's good or bad or just a product. And one of the things that we were talking about is really just how much money is spent marketing for and against the annuities. I think one of the most known to hate annuities would be Ken Fisher with Fisher Investments, and they spend a lot of time on telling you why he hates them, and you should too. But I can tell you a lot of the academic research, and even whenever we're looking into the CFA, it's really not that simple, and this is not necessarily a product that you should totally ignore. We don't think Ken Fisher is given its due. It's doing great probably for him on a marketing component because they are often sold wrong. And we have the image here of a used car salesman, or I think the other one that we were trying to look for is a life insurance salesman. And those that don't know, we actually come out of a life insurance company. So we have a pretty good background on how insurance works. And I also note that Chris looks a lot like this guy. He's not wearing a tie and he's got a coat on. But Ken Fisher is often right if you're buying annuities from people that are not selling them correctly. And many annuities are not sold correctly. So we thought we would spend some time and just give you what the GWS take is. Let us weigh in on annuities.
Well, there's various different types of annuities, deferred versus immediate and fixed versus variable. How do you begin to start to break that down?
And then we get into the riders, right? So instead of doing that and trying to go through every different variation, I thought we should just spend some time on what is an annuity. And an annuity is an insurance product. And they can be very helpful in retirement. And to give this an example, let's say you're 55 years old. Our stick man's 55, they're going to retire at 65, and the average life expectancy is 80. That means they need to save for 25 years. Now, our stick man makes it to retirement, and he runs into an eraser, and he's gone within 5 years. Well, that's not a problem for the retirement because they had 20 additional years saved for, and it's not great for the individual, but there's no financial burden. Actually, there's a surplus as an inheritance that is probably shifted to his family. So this is not something that's detrimental to the retirement plan of Mr. Stickman. However, what if you live 40 years? Because if you live 40 years and you save for 25, you're going to miss out on 3 or that 15 years that you didn't save for. So the natural thing to do is to plan for 40 years to support yourself. Well, imagine if we had 10 individuals and they were all saving for 40 years because each individual doesn't know if they got 5 years, 10 years, 15 years, 20, 25, 30, 40 years. So they each need to assume that they're going to save for 40 years, and that's the target. And people may not be able to do that. They may not have the financial means. They may not have the time. There are a lot of reasons on why they can't do that. So an annuity can solve this problem. Because if those 10 same people each saved for 25 years, then the individual that died 5 years in, those assets can be shifted to the pool of people that are remaining. And those that live beyond 25 years, average are going to die in 25 years, but there'll still be surplus left over. So with an annuity, you can actually bring down the overall cost of saving for retirement. The 10 individuals only need to save for 25 years, or 250 years total, versus the 400 years that they would have needed to save, being that there's uncertainty in their retirement.
That's the idea of mortality credits, right?
Right.
Each income payment you receive is part of return of principal, interest, and this mortality credit that becomes a larger portion of the income as you get older, and are one of the few left still drawing income from the pool.
Absolutely. So this is why we say that it's not an investment vehicle, it's an insurance vehicle. Because what it's doing, it's transferring risk. And it's transferring the risk of living or outliving your money. There are pros and cons. If you die within 5 years, that means your heirs are not going to receive the money. As you mentioned, there's a lot of riders and other things that you can put it on, but let's just keep to the plain vanilla of what's going on. And with risk management, there are different options that you can take. You can ignore it. We don't recommend that. You can reduce it. I think the way that you would reduce this is probably not advisable. You could become a heavy smoker and a heavy drinker, and you're probably not going to worry about a longevity incident. Once again, we don't recommend that. You can avoid that. Really difficult to avoid this risk. It's possible, but it's detrimental to your health. So don't avoid that. You can exploit it. Sounds like a horrible word. I would actually argue that this is what the insurance is doing. There is a need, and they are trying to find a solution. So they are on the opposite side by trying to exploit the issue. Not in a bad way. They're just providing a solution for this problem. You can accept it. If you accept it, you can either accept that you may outlive your assets, or you could do the prudent thing, which is save 40 years, or if that longevity is, or you can transfer it. And that's what an annuity is. It's basically transferring the risk of you outliving your money, and it actually could reduce the cost of saving for retirement for each individual that's doing it. Of course, what do you lose? You lose the ability to transfer any inheritance for the money that you do. Once again, there are some riders that can take that.
And you mentioned sometimes selling it incorrectly, selling it as a silver bullet, and it's insurance. So it does not and should not have an expected value that's positive.
Right. It is insurance. It is not a silver bullet. If you're looking to transfer this risk of longevity, they make sense in your retirement. But let's look at the insurance products. Because they are an insurance product, they're complex. Chris and I both have sat for the CFA examination. It's a very difficult test with lots of numbers. But the actuary test is far more difficult than the CFA test and deals with a lot more math. And the actuaries are the ones that are setting up the math to be able to transfer this risk. It's complex. And because of complexity, it really lacks clarity. It's not right or wrong, but I can tell you that these are not transparent products, right?
You mentioned working for an insurance company in the past, and we had great products there, but even if you're trying to figure out what's going on behind the scenes, it was hard because you don't have the information.
Absolutely. They don't release a lot of the information, right? There is a proprietary product. I remember Northwestern Mutual, they would talk about their black box. Fine company, great company. They want to hide the reason that they're a great company. You're not going to be able to get that information easily. That doesn't mean that these products are wrong. It just means that they're hard to understand. Also, you mentioned insurance as it's always a cost. It's a zero-sum game. Let's imagine we all buy fire insurance on our home. So we pay insurance. Well, let's say that you have a fire in your home and it replaces your home. You got to have a large pool of people to do that. Everyone's premium is going to help support to buy whoever's home caught on fire to replace it. Are you a winner in that scenario? No, you lost your home. You probably didn't want to deal with that. You're thankful for the insurance that it's there to help replace it, but you're not a winner. What about the individuals that didn't have their home and it didn't catch on fire? Are they the winners? No, they gave the premium and they lost probably a couple $100 for the month, and they got nothing for it except the protection. So who's the winner? Well, the winner is probably the insurance company because you have to replace the home, and then they also still have to make a profit. So then there's administrative costs and everything. Now, insurance companies have similar profit margins than many other companies, so it's not like they have this bonanza. They're providing a service which is transferring the risk which is needed. If your house burns down, you want to be able to replace it. But in those scenarios, no one was actually the winner in the thing. So insurance is a zero-sum game plus administrative costs. Because if you could get a bunch of people to agree to do it without the insurance company and they all pay in, it would actually be less because then you wouldn't have to pay the infrastructure of the insurance company. And then also conflicts of interest on the payment scheme. And that isn't to say the payment schemes are wrong or set up incorrectly. We would just recommend, especially when looking at these products, to understand how the person who is selling it to you is getting paid.
Right. And that's complex as well. Right?
It is complex.
You could get an upfront commission and a trail, or so you're incentivized to sell at a higher price. But the exact opposite could be true. You could also be looking at low-cost annuities and you're billing other assets, and maybe there's the incentive to not buy the low-cost annuity because you're still getting paid on the other assets that are under management.
So right, understanding it. So the way that we do manage variable annuities, and there's even some fixed annuities that are out there that we have recommended based on what we're going over here. But the way that we get compensated on investment assets is exactly the same schedule that we get compensated for annuities. So we are not incentivized. Let's say that all of a sudden it's a weak quarter and we have our revenue goals. We're not going to go and say, well, let's do that front commission so that we can make our revenue goals. No, we get compensated the same exact way to try to remove the bias on which we favor. So be very careful on how the person is getting compensated whenever you're looking at these products. Now, questions to consider whenever you're buying an annuity. And this is for any of the advisors, but also any viewers that are out there that's considering it. I think the first question is, do you need guaranteed income? Because that's what this product provides. It's that pooling of risk to help ensure that you transfer the risk of outliving your money. If you don't need that, then annuity probably doesn't make that much sense for you. Now, we talk about it not being a silver bullet. There may be cases where you want a certain amount of guaranteed income, especially on a behavior basis. The market's selling off, but you know every month you're going to get this check, and it's your 40th wedding anniversary. You definitely don't want the market dictating your concerns and fears about going out and having a nice dinner, right? You want to have some security knowing that there is some guaranteed amount coming in.
And you don't want to be selling your portfolio at the wrong time.
Right. Yeah, you don't want to be selling when the market's off as well. So these things have a place. You probably already have some guaranteed income though. If you have a pension, and most people have Social Security, look at those payments to see, well, I do have some guaranteed income. Do I need anything more than that, whatever I'm considering it?
How do you look at inflation risk with some of these annuities?
So depending on the rider, they can be complex. A lot of times the way that we see these things sold is off the 4% withdrawal rate. Hey, look, you got this investment account to deal with this. All the academic research says you can take out 4%. With an annuity, you can take out 5%. Look, you can get paid more. What is often ignored is that 4% was assuming an inflation rate raise each year, where that 5% is oftentimes flat. Not all. There's all kinds of different ways to do these products. And even within the same product, they'll change from year to year. So the assumption with a lot of that 4% withdrawal is that it does inflate, where that 5% oftentimes is flat. So you want to be aware of how that payment's going to increase, because we know inflation is going to increase over time. But once again, do you need guaranteed income or desire guaranteed income to kind of have that comfort, and also consider what you are already getting paid? And when we do our cash hub, because we try to do a different method, we take that in consideration. What do your investments need to provide for your monthly need, and what guarantee do you have? Then we're going to cover that delta. And that delta could be covered with an annuity. It doesn't have to be. There are other ways. Is the client seeking guarantees against losses? Especially in 2008 or 2011, or even recently when there's a strong correction in the market, we see a lot of people start to go to these products because somebody says, well, you can have all the upside and none of the downside risk. And I believe in tan staffel. There ain't no such thing as a free lunch. And then just the common wisdom of, if it's too good to be true, it probably isn't true. And I think that is applicable here. I can tell you, whenever we get into looking at some of the products that are sold, there's a lot of legerdemain. Now, I like to use that word. Basically, that means sleight of hand. And what we'll see is an equity index annuity will say, you're going to get all the upside in the market, and we'll protect you on the downside, and we're going to have this phantom account over here. I call it a phantom account because you can never actually take the money that phantom account is. If that phantom account says $500,000, you can't say, well, give me the $500,000. What you can do is get an income stream off of that $500,000. So that money isn't there. Now, let me unpack the complexity of this. There's a rider to get that phantom income. I've seen it from 3 all the way up to 5%. Now, if capital markets are expected to be somewhere between 6 and 7, you're giving most of your gain up paying for that fee. So the upside is significantly limited. And then there's the different things on where you got a maximum capture that just becomes, I've seen phone book size prospectuses trying to explain that. End of the day, to make it simple, is you're not going to get near what you would expect in equities because of the rider cost. So ultimately, you're going to end up getting what that phantom income is. So then they'll say, well, yeah, but I get this 5% increase, and then I can take that out. And when we look at what the actual economic benefit is, what they're doing is they're saying, well, you're buying this and you're annuitizing it at 65, but in the fine print, we're going to assume you're 55. So the actual income stream that you'll get out of that phantom income is if you were annuitizing early, meaning a much lower amount that you'll be able to get out of. So then when we say, okay, well, what's this income stream? If you just bought a fixed annuity, a lot of times the fixed annuity would actually have paid you more. And so there's a lot of moving parts to make it look like you're getting this substantial rate of return when it's almost what you would get in a plain vanilla low variable annuity or fixed annuity. So there's just a lot to that. So be very aware that there's a lot of things being done to make it appear a lot stronger than what it is. You're not going to get the upside, and what you're guaranteed is really not that high of a guaranteed rate. So is the client seeking to access to growth? How are you getting growth in the portfolio? Because anything that you can do in a variable annuity, you can do in an investment account. And then with an annuity, you're going to have market performance, just like in an investment account. You're going to have your manager performance. That can either be an addition because they outperform the market, or it can be a subtraction because they underperform the market. And then you're going to have your investment accounts. Variable annuities are going to have sub-account fees just as much as mutual funds or ETFs. So you're going to have a drag because of cost for the investment. And that ends there with the investments. If you're in an insurance product, you're going to have a mortality expense, which is that insurance cost. It's not a right or wrong component depending on what you're trying to get. But if you're seeking only growth, you can do the exact same thing in an investment account that you can in an annuity. Now, I would say that there is an asterisk on this. Because there's a tax deferral treatment with with annuities. I keep saying variable annuities, but any annuities, they are tax deferred per the IRS guidelines, which may mean that the mortality expenses are actually a lower cost than the taxes if you're going to trade more frequently. And this is where we think a variable annuity could make sense if you're trying to access growth. If you're in a high tax bracket and you want a lot of trading, then this could make sense. And now that's assuming the tax code doesn't change. If we get higher capital gains treatment, then annuities are going to look even more attractive. Right now, if you're more of a buy and hold, let's say you just buy the S&P 500, you're probably going to do better in the S&P 500 than a variable annuity that holds the S&P 500. It's just going to have some additional costs that are not in the investment account. And then whenever you pass and you're sending the assets to your estate, they get a step up in basis. They wouldn't get that in the variable annuity. So there's a lot of things to consider when you're doing this. Not a right or wrong. We would say our take on annuities, they're not good and they're not bad. They're just a product, and they're an insurance product, and that can be used quite well, especially for some people that are behind on saving for retirement, because they can bring down the overall retirement costs. In addition, there is some tax shelter features for those that are in higher brackets that may want to consider that for part of their portfolio. So, summary. When is an annuity the right choice? And it's whenever the payment scheme is similar to the alternatives. So once again, know how the person selling it to you is getting compensated, and make sure that they don't have a conflict of interest, because these are very complex products and that they can slip in things that you really didn't intend to have that drag down performance. So make sure that they are explained and you understand the pros and cons. And when you need or desire guaranteed income, whether you need it because you haven't saved sufficiently for a 40-year need, or you just want some certainty in the amount that the check is going to arrive in your mailbox each month, and or that there may be some tax benefits because you're in the higher brackets, and this allows you to defer, especially if you want a very active trading account. And that's where we use them. Anything that you'd like to add, Chris?
No, a majority of ours are those variable annuities that you talked about that were really in that tax shelter. Maybe they had a plan to annuitize at some point and they didn't really necessarily need it 20 years later as the annuity's grown.
And we're looking at a product that is designed to have the same payment scheme as an investment account. And we looked for a product that met two criteria. It had a large amount of selection so that we could get different points or get access to different types of market factors, and the mortality and expenses were fairly low. So the insurance cost wasn't a big drag on the investment performance because a lot of those were looking for tax deferral.
Right. We want to be able to add some value in the investment management. Like you said, the last thing you wanted to do is just sit there holding an index and charging 20, 30, 40, 50 basis points more than what you could have outside of the product.
Right. So if you have any questions, these are complex products. We're always available at the investment committee, but so is your lead advisor. Feel free to give them a call at the number here on the screen, or reach out to us. You can also go to the website and request a meeting with a lead advisor. And if you like this and you found it informative, please click the like button. That does help us in the search feature. We kind of get put off a little bit higher up off to the side. If you think this is something that you would want to share with any of your friends or acquaintances or family members, go ahead and hit that share button. And while you're down there, if you're not already, subscribe to this channel so that you get more updates from us at the Weekly Market Insight. Thank you and have a good day.